Welcome to the Value Builder Podcast, where we focus on real estate with a value-add mindset. Real strategies, real operators, real outcomes. Let's dive in.
All right, Value Builder community. Today I've got Nick Terry with me out of Houston. He runs Rifle CRE, a tech-enabled boutique brokerage doing office, industrial, and many other cool things. But here's the thing. He did not build just your traditional commercial real estate shop. It's really a whole ecosystem, property management, development, construction, office, industrial, and other asset classes. And it's really fascinating model. I met Nick first in Atlanta and Small Bay Summit, and we're going in New York, and we're going again in Atlanta. And I'm really excited to get in this conversation because we're going to learn a lot. He is running right now a couple interesting projects, and he's going to share at the end, so you want to stick around. So Nick, how is it going, man?
Man, it's great. Thanks for having me on. Appreciate the invite.
Nice. So Nick, you really have a unique model for our audience. There are many operators, many of them industrial. There are some traditional brokerage shops, but you kind of, fall in both spectrum because it's a very unique model. It's not your traditional real estate brokerage shop, as I mentioned. Before we get into all nitty gritty, do you mind explaining what is your angle when you describe your shop? What is your model and how do you make it work so well?
Yep. So my background, actually going back over 10 years at this point, was in office tenant rep. And coming into the pandemic, I was on the office tenant rep team at one of the global franchise brands. I was in their Houston office, and coming into the pandemic, struck out on my own and started my own firm right before. It was January of 2020. So the timing of that was super interesting. I've got friends and colleagues at shops of every size in Houston, and had a lot of folks that were like, hey, come join our team, come do whatever. And I really thought hey, I think I could recreate the same value proposition of a brokerage on my own for less, which was a great thought to have right before kind of the world got turned upside down. So struck out on my own very quickly. All of my pipeline of client deals dried up. Nobody was doing anything because 2 weeks to flatten the curve turned into 2 years. And so I pivoted from office tenant rep. I had always done a little bit of industrial. My college degree from A&M was in industrial distribution, which is supply chain. So I always kind of had my hand in industrial deals, but it wasn't most of what I was doing. Well, I pivoted in 2020 and found some industrial landlords that I started, they were like, hey, we need to fill these things up and get deals done. And it seems like all the brokers are on vacation for the next 2 years. Started building up that side very quickly. We had some success there, started building the team. Then we started getting into buying buildings. So in 2021, I put 2 small bay deals under contract, ended up partnering with one of my good friends who had to exit in the software industry and needed all the bonus depreciation he could get. So we took down it was a total of 60,000 feet across 2 properties. Closed him very quickly, and his deal was like, hey, all I know is I need the depreciation, but he's not a real estate guy at the time. He had done a little bit with occupier stuff for his own businesses, but he'd never, renovated and repositioned multi-tenant industrial parks. And so out of that, we birthed the property management company. Pretty natural progression for us because my wife was with CBRE for a long time managing office buildings. And so industrial is, much lower touch than office. And so we started the management company. Those buildings were a big success, and we thought, hey, we could keep doing this. And so we did. And so we started doing the investment fund model. So that kicked off our investment fund business. Through the investment fund business, we got fed up enough and realized these interior contractors are gold plating these deals for commercial, but it shouldn't be this expensive. And so we actually started our own commercial construction company. That business went well enough that it actually grew and acquired another one that had 30 years of client relationships. The owner wanted to retire. And so last year, our construction company acquired another company. So we've been growing there. Most recently, you didn't even mention, I don't even know if you knew, but I was looking at our property management costs, and we were spending over 6 figures a year to cut the grass at these business parks. So we started a landscaping company. And we found a really good guy to run that. He's a go-getter, signing on all these big major contracts. And so even that company is having a great first year. So it's been fun. A lot of these businesses were born out of necessity. And our kind of model is everything we do touches commercial real estate. So from brokerage all the way through to the service providers, et cetera.
So it seems like you've very well integrating everything virtually, all the services. But right now, you mostly do those services typically on the deals that you're a principal, or you also offer that to those services to other people as well?
Man, our motto is anything for a friend for a fee, right? There's enough to go around. So One of the areas where we've actually been able to grow organically is when if I do have a principal interest in, like we had a park I sold last year, became really good friends with the buyers. I flew out to the West Coast, met a bunch of these family offices and funds that are trying to get into the small bay space, created some good relationships. And I'm kind of an old school small town guy where your handshake means something and look somebody in the eye, treat them right during a deal. And you do that enough times and people want to keep working with you. So we've actually been able to sell assets that we had an ownership stake in and made a great return, and then continue to add value to the upstream buyer. The guys come in, they let us keep the leasing, they let us keep the management, they want us to help them buy more deals because we've been a good deal partner. Even the most flattering part, I think, for us is even when we're sitting on the opposite side of the table, right? You're buying a deal that I own and we're negotiating this thing out, but we treated you so fairly and respectfully that you want to work with us after this deal is done. That's been very flattering. So we've been able to grow the business that way. And our rule is like none of these businesses are a hobby. They're all freestanding, different ownership structures. And so they all need to be supporting on their own. So yeah, on the brokerage side, we still have a very active tenant rep book. We're working with, Brookfield Properties is one of our clients, right? So we've got
That's amazing.
We've got all the way down from like one guy that, has a few $1 million that he just got in a 1031 deal and he needs to go place that, right? Just an individual owner. Nobody's kind of too big or too small, which is neat for us. As long as we can add value, it's a good fit for us.
Yeah, but that's the key. You keep the service contracts after that once you actually leave in the sell. That really speaks volumes about the way you do business and the way you handle transactions. Because definitely most of the time you're on opposite side of the aisle, right? And
that's right.
And doing them shootout, and people a lot of times don't talk about the transaction, but that's great. So let's lean in on the construction because I know you have extensive background as well, and you guys also do construction when it comes to build outs, right? For flex build outs and office build outs.
Yep. Yeah, our guys have been very busy there.
How much of the business? How big of the business is that part of the vertical? Is that significant, or is that?
No,
sizable?
in terms of headcount and revenue, that's the lion's share. Especially because we bought an existing company that had their own book, right? So we kind of brought them into the fold. We brought in a great guy with some great relationships to kind of increase that revenue stream to maybe do some bigger deals. The interior space is a little bit limiting just because there's only so many interior deals. But the guy we brought in also had ground up experience. And so now we're expanding that group into doing ground up new construction too, which has been good, right? Once you have kind of good processes, good values, a good team in place, it's very easy for them to expand into that. So they're on fire right now.
Would you mind walking me through, let's say, how the construction is done when you're working on someone else's property? Let's say on our case, we do build outs in house for the tenants.
Sure.
And a lot of times we take the risk on change orders, delays, permits.
That's right.
But we have a lot of margin because we're a principal. But if you're not a principal, right, there is normally in industry, you want to isolate TI responsibility from the broker, pushing back towards the GC or the tenant, right? But in your situation, you kind of know if you're one man, if you're covering all the bases, you actually catching all the fires. How do you mitigate that?
Yeah. So is this you talking about like a small bay deal, like the stuff you guys are owning, small bay flex, industrial?
Oh yeah, whatever we small bay or office. You're building out a small office, let's say,
sure.
like 2,000 square feet office.
And I've had this position ever since I'm a tenant rep. Like landlords do more construction than anybody else, right? Like you guys are, if you're a sophisticated tenant that's going to manage your own construction, you're doing 5 to 10 year deals, right? Let's just average that to 7. You're doing one big construction project every 7 years. Unless you're multi-site, regional or whatever, and you've got 50 offices in the Southwest or something. Then maybe you've got an in-house construction manager and that's all they do. But so in my mind, landlords are better positioned to have not only the expertise, but also the relationships to make sure the project goes smoothly. So first, when we're on the ownership side, I want to take on all the construction risk. It de-risks it for the tenant. And honestly, most tenants are happy to get that, a turnkey deal versus a TI allowance. Like it just makes the deal easier for everybody. In most of these deals, you're not rebuilding the most complicated chemicals lab ever where there's a ton of risk, right? Like paint carpet, move a couple of walls, upgrade the air conditioning, rebalance the ductwork. I mean, these are very easy deals that everybody should have done 100 times. And so everyone's very worried about monsters under the bed because they all have that story of, I did a turnkey deal and got burned. But
Yeah.
if both sides can negotiate a very clear scope of work, it becomes very, very easy to get the tenant what they want. I actually go a step further up the supply chain. If I'm an owner in something, we don't put it on the market until it's done. We do everything speculative.
Whoa.
Just coming out of the office world, I saw even big sophisticated tenants. I mean, we did a full floor or most of a floor office lease for Shipley Donuts, which is they're a big donut franchisor here. And so their corporate office, they needed to get everybody under one roof. They wanted a real nice, took the top floor of a really cool building in the Heights. And seeing them go through the construction management process, and they build stores. I mean, they have thousands of stores across the US, and even still the construction management was such a challenge for even a very, very sophisticated group versus similar size deal. It was a chemicals company. They wanted move-in ready. And they had such a better, I would say, deal flow process, right? The deal, they went in and the landlord, what they did, and this is actually really smart, I think. They took a full floor of office space and they speculatively built out the lobby and the first few offices, and then it was just wide open, right? Concrete floors, but wide open. You could see both sides of the windows on the floor plate. And so you kind of got a taste of what the finished palette would look like. And the important thing, especially in our city in Houston, they had the permits in hand to build the rest of it out. And so you took in Houston, it can take you 1 to 2 months just to get a permit.
Which is fast.
And they could have the space done within 2 months, right? They could say, hey, you sign a lease, you could move in this quarter.
Mm-hmm.
And so they've already got a taste of the finishes. They've got a taste of how it looks, and they can see and visualize, right? Even the most creative tenants can't visualize the space. So, and the landlord already had the cost built out. And so it was a very, very very easy deal for us to negotiate. And they won the deal, right? All the other landlord reps came back to us and were like, hey, how come we didn't get a look at that deal? It's like, you didn't have move-in ready space.
Makes sense.
And what we do in industrial, the way that plays out, your question is about our construction company. We get a lot of looks at deals on the construction side because our ownership is based in owners, property managers, and brokers, right? We're all real estate people that know construction exists to get deals done.
Mm-hmm.
Somebody told me early career, nobody will value what you do like you do, right? When I was a tenant rep, I just thought tenant rep is so important to the deal. We're aggressively representing our tenants. But on the tenant side, they're like, we need space. We want a good deal. That's about as sophisticated as it gets for a lot of them, right? So on the construction side, it's very easy to get these pie in the sky. We make your dreams turn into reality, et cetera. But the tenant wants a space where their people can operate and they can operate in their core business and make money. The landlord wants to get a deal done.
Exactly.
And that's kind of that's where construction fits in. We need to make them space where they could work. And so it's not quite as sexy. And so when you have brokers that come in and a company owned by a bunch of real estate investors, we know what the market wants. We can tell you, hey, look, I know you think you want to save some money and do this boring gray industrial carpet, spend another 60 cents a foot and get LVP in, get the fake wood LVP. And I can now tell them, I'm like, hey, I'm not a waiter upselling you at a restaurant so that you tip me more. I'm telling you, if you spend $5,000 more on this construction thing, your space will lease 3 times faster.
Yeah.
Because it's not like my hat of being a broker and an owner and running the management company. That doesn't go away, right? You're still getting the benefit of all that expertise just in a construction format. And so I think bringing that expertise on the contractor side really resonates well with our clients.
Yeah, and side note, I just vinyl. It was $4 or $5 a foot, and it was barely more expensive than carpet. So definitely, but it takes effort to.
We need to have our guys come on. We need to go on the road because I can get you paint and carpet for $6, right?
Exactly. Yeah. So what really, I just want to highlight the key points we just mentioned. I was looking for, something that's going to come out there's some nuggets, but really comes down to about not having those change orders, those horror stories, just really coming down to being experienced professional and really getting to the real bottom line scope of work. And typically, as you say, you're not going to have those horror stories. And when I think back right now, if you're doing those traditional build outs that is not out of order, I don't remember something getting off the rails on a permit side or on a change order side, but it comes down to just being able to take the risk. I think being take the risk and driving the bus and kind of, not guaranteeing that number. This is going to get done and how much is going to get done.
That's right.
Right. And if it bombs, well, that's on you.
That's right.
All right. Awesome. All right. So how about we dive in a small bay industrial, and maybe I can share what's going on here in Midwest or Chicagoland. I see this year there's more deal flow compared probably to last year, though. To get sellers to accept the numbers they need to accept, it's still quite challenging. And of course, maybe we're spoiled with a 2022, 2021 era, right? When everything was penciling out. But that's my take on it. I see more deals coming through. Though to get them done, it's a little harder. What do you see in Texas? What's your take on a small bay industrial?
Yeah, I keep hearing a lot like inventory's picked over, the bid sheets are so long. On the principal side, I use the Dave Chappelle meme when he's got the Coke on his like lip and he's like addicted to the cocaine or whatever. Our guys, we've been able to get such good returns that not every deal will pencil for our format. Our capital is a little more expensive, right? But there's a lot of operators with cheaper capital that can come in and pay, 10% more.
Yep.
So we've seen a couple things, right? Like we are being still very, very selective on what we're buying for ourselves because our model is it is what it is. And we're a one trick pony. We're not going to change that and start buying the more stabilized stuff. But we've been able to send a lot of deals to third parties that are like, hey, we're happy. We love a 25% return, which is below my no-go, right? Like my line in the sand is 30. I need to see a real path to 30 to move on it.
Yep.
25 is still a killer deal. Nobody's unhappy with 25 other than me. So there's a lot of deals that I'll underwrite and I get something in the 20s where I know a lot of people will still operate. And so I still think there's plenty of, deals out there if you're willing to do the work to underwrite. I think the hype around the small bay thing, there's a lot of people that think they're no office, steel front door, contractor garage. We talked about this in New York, like what I call it's like self-storage with a man door.
Yeah.
Right? Like there's still nothing in it. It might have a bathroom tucked in the back, but that's not like the product that I want. You're such a commodity at that point. You can't differentiate with office finishes and branding the park. Like I want the stuff that almost looks like a Class A retail center with a roll-up door on it. The finishes are higher. You can be more picky on your tenant mix. And those deals are still out there. A lot of them are heavy office. You have to be able to do some demo. The areas where we're looking, most of the product was built in the 70s or 80s still.
Yeah. Just to put a little more color, for the audience, Nick had really great visuals and I've seen his products. Pretty much what he's referring is what me and Shay sometimes say, what he's making a lot of times from flex space or small bay industrial in a retail-esque type of facility, which is sits in retail location, and you're dressing up the lobby, dressing up the facade that looks like almost a retail store. So you open up the store not only for service contractors, but someone who is e-commerce or someone who has customers to have in his lobby, and they're willing to pay $1, $2. As a matter of fact, right now. I just mentioned about vinyl floors. I did two units, and I spent probably about close to $8 to $7 a foot. And we did epoxy floors, LED lighting. Pretty much the warehouse will most got to the level where it seems like a showroom. And in the front, we just remodeled the bathrooms, changed the windows, tall baseboards, the way you do it. Probably most like in residential, and I'm commanding $1 more, and I signed one. Of course, it's kind of correlated to lease increase, but definitely I'm commanding $1 more for this type of increase. When we spend probably $7 in additional turn. So I just wanted to give a context to that.
I always look at it. I had to educate one of my partners. We call it new math, right? So you're getting another $1 in rent because you spent $7,000 in finishes, right? Another $7 a foot. If you take that extra $1, which goes straight to net income if you're running the property correctly, right? Like your OpEx is already covered. That extra $1, put it on a 7 cap rate, and that's $14.28 in increased property value.
Yeah.
So you might do a 3-year deal and get an extra $3 per foot over the life of that lease. So your
Exactly.
break even on that extra dollar in cost is way further out. But when you look at like value add guys like me,
Elation.
that's right. You say I spent 7 and I increased the property value to 14. I just doubled my money. If that was a slot machine, we'd put our money in every single time. We're going to get 2 to 1 on our money.
Exactly.
The challenge, and we talked about this in New York too, is you have to leave enough meat on the bone for the next guy, right? If you do all of those doubling of the monies, then the next guy comes in, and when he underwrites the deal, the returns are just like this.
Mm-hmm.
He's just going to get base rent increases every year because all the value's already been wrung out of it. So what we're trying to do is we look at the yield curve. We just did this deal, we increased the rent, did this deal, increased the rent. So the returns are going up. The second it starts to flatten is when I put it on the market to sell it.
Mm-hmm.
Because I want the next guy, you or whoever, when they look at the deal and underwrite it, they, I had this, they get this. They look at the yield curve and they like, oh, I like this. This is attractive.
Let's keep going.
And so, yeah, there's enough, maybe I've done half the units and they can see the proof of concept. Like, hey, in-place rents were, call it 9 net effective, and you renovate it, you can take it to 12. They're like, well, here's another 10 units that haven't been done. That's $3 a foot in rental rate. That's a very big increase in NOI if we do those. You've given them the proof of concept.
That's a highlight. You do not all the units, just some of the units, and you leave some of the units that are finished, the next guy to finish.
That's right.
And
some of these tenants are so hard on the spaces that you should be redoing them every 3 to 4 leases anyway.
Every week, I read hundreds of commercial real estate articles from across the U.S. and around the world. I connect the signals, break down the Fed moves, and share real case studies, not theory, from my 2 decades of real estate experience and actively doing deals right now. My team and I spend 15 plus hours on a weekly basis and deliver this to you for free. You can read it in 5 minutes. So every Sunday at 9:07 a.m., you'll get major commercial real estate news that matters, one Fed insights that matters, one deep dive case study from me or one of our operators who already made the mistakes, so you don't have to. Thousands of commercial real estate operators and investors read this newsletter, especially in the value add space. And don't take my word for it. Check out hundreds of reader testimonials online. Plus, when you subscribe, you get instant access to a Proforma underwriting tool, the same one we use every single day to underwrite value add deals. Now, this is not for you if you're looking to get rich quick schemes, or if you're looking for theory and hallucinations, not real numbers, or you're not serious about commercial real estate. But if you want real tactics, real deals, real results, no bait and switch, go to joinvaluebuilder.com and subscribe for free. And see you there, guys. Yeah. Well, actually, just helping to make my mental decision. The property I was talking about, I was debating to lease up 100% and then put it in the market. But right now, I think I'm going to leave, even if the unit is finished, I'm going to leave it then not leased. I'm going to leave some money on the bone. And I'm just gonna lease it, probably call it 80% occupied, and that's how I'm gonna leave some profit to the next guy who's gonna pick up and carry this property for the next 3 years.
Do you, on the operations side, do you guys intentionally stagger your lease roll?
Do you mean like stagger, like?
So what I always think of, and I hate to quote every business book I've ever read, but like beginning with the end in mind.
Mm-hmm.
I think about, what does this OM look like when I sell? And so I want to almost make like a menu at a Michelin starred restaurant. Like, what's the menu that the end buyer is going to get? What's the banker going to see when he pulls up this OM to underwrite the deal for our future buyer?
Mm-hmm.
And so the last one that we sold, where I was a principal and I was serving as asset manager, I would look and I would be like, okay, we have 16 units here. They're all the same size, beautiful property, which I love. I just love the kind of uniformity of the unit size. But I would say, okay, a fourth of our leases expire in the next 4 to 5 years. So we're not doing any more 5-year deals. I don't want half the park coming back in any 1 year, because then the lender's going to freak out.
Yeah.
So we kind of said, okay, if we average a 4-year deal, we want to do no more than 25% of the park rolling in any given year. And I try to spread those out by quarter. So we would do some wild lease terms. I did like a 39-month lease term with no free rent. Usually you see a 39 and you think 3 months free on a 36. But no, I just did 39 because I was like curating the menu, right? I was like, I want this lease to expire Q3 of 2028. So that every 3 months, there's only one unit coming. And if we can look at the market and say your lease up time is 60 days, then the lender could underwrite and be like, there's a very reasonable case that we never get more than 1 unit vacant at a time, as long as the operator is doing his job. And so we're spreading that rent roll out instead of getting the WALT and being like, this is, WALT is such a big tenant metric.
Yeah.
I almost want a lower WALT when I come in so that I can get to market rents faster. But then when I sell, I have found that spreading out those lease expirations is more valuable to a lender and thus to the end buyer than having, everything. This whole park is on a 5-year deal. So you're really good for 4 years and then you're going to be 100% vacant in 5 years from now.
Yeah, I think that's another great idea. That's another highlight. Definitely, I don't think Walt has any relevance in the small bay industrial because the game is keep getting rents to market. Staggering leases, no, that's a great idea. I think my strategy was that to have more than half longer term leases and let's say 20-30%, that whether it would be like a shorter term or even month to month, I don't extend them for the next guy to keep increasing. But I think, staggering them, the way you explained, probably is more methodical. But do you do staggering before you go to market and you go to tenant, okay, let's do this deal, I'll give you a free rent, or you kind of have the plan before the stabilization that, no, that's how we're going to stagger lease? Do you do staggering, at the first lease up, or you do that when you kind of, getting ready to dispose?
Yes, is the answer to the question. So when we come up with our leasing plan, we kind of we build our cash flow model by month, and we just highlight whenever that lease goes vacant, especially if it's below market. We're assuming a month of construction, a month or two of lease up. So it's a 3-month downtime total. And we almost have a quota, right? It's like your Scrabble letters. Like you've got three 5-year deals, 3 3-year deals, 3 4-year deals. And so you have to pick them and go in order. And it's like, you can't go 2 of them in a row. So if you just did a 5, your next unit, let's go for a 3. And then let's go for the next one for a 4. And when you're starting out, that's kind of how we view it. Like I just, keeping it simple, I just don't want to do the same turn length twice in a row.
Makes sense.
And so, there's different levers to pull, right? If a tenant's on the hook and they're looking at a 3, maybe they won't do a 5, but I'm like, hey, if I give you a month of free rent, can I get you to a 4? Or if I get what's something we can do? Because I'm thinking that month of free rent costs me, very little, especially if it's outside the term, but I get the value increase of the rent, of the cash flow. But then it's kind of setting up that end buyer to see a really pretty picture at the end of it.
Exactly. Yeah. Taking risk on the table. Yeah, that's great.
And as you have to adjust and see what you've done too, right? If you're, we kind of know early on, we're just going to go 5, 3, 4, whatever. But then let's look after the first year of operations and see what the rent roll looks like and be like, man, we have a big gap in 2028. We need to push some lease roll to 2028.
Exactly.
Or, hey, 2029 looks really scary. Nothing can expire in 29 this year. Anything we sign has to go 30 or 27 or 28, right? We can't expire in that year. And so you almost blacklist a certain year of we won't have a lease expiration in this year because we already have a third of the park coming back and we can't fix it.
Awesome. Great nuggets. Thank you, Nick. Let's go a little bit more on leasing, and I'll give you the flavor of what's going on here in Chicagoland. So in the small bay, we used to do short-term leases, 1 year, 2 years, during 2022, 23, 2021. Right now, I started doing 3 to 5 year leases. Leasing activity, obviously, compared, 2022 is down, but it is even down a little bit compared to last year on a small bay industrial. And I'm measuring that typically from appointments, how much incentives we have to do. Right now we're probably free rent 2 months standard for 3 to 5 year leases. We haven't done it in the past. Rents, I would say, flatten in Chicagoland for the last 12 months. I didn't see much increase, which is also interesting. In terms of appointments, how many appointments scheduling for tours for the tenants? Our average, let's say, we try to schedule 5. Right now, probably achieving maybe 2 or 3 a week. So leasing is definitely kind of stabilized. I don't see much increase. And it's getting a little more challenging to fill in as fast as it used to be. What do you see in your market?
Yeah, I had this conversation yesterday, and the analogy that I used, yes, it has slowed down. But when I say slowed down, it's almost like, when you're driving, we go ski a lot. So sometimes we'll drive to the mountains, and there's just stretches of, it's so flat you could see your taillights.
Yeah.
So you can push it, right? You can go 90 miles an hour or whatever. I'm not saying people should speed, but we do.
Mm-hmm.
And so you're going 90 miles, but then you get into that small town and you're like, oh, I got to slow down to 65, right? You're still going over a mile a minute. You're still going to get there and not that much later, but it feels like you're going backwards. I feel like in Texas, that's the way our economy tends to do. Like when things are good nationally, Texas is just doing great. And then when things are kind of slowing down a little bit nationally, Texas, like it feels like we're going backwards because we're so used to going 100. And that's what like our eyes are used to seeing. And now it's like,
Mm-hmm.
this is just equilibrium for us. There was a guy talking the other day. He said, Texas is really funny because you guys just choose not to participate in national recessions. And so, I think that's where we are. Yes. Like we're starting to see some free rent creep into deals. We're starting to see some concessions, but the things that I really care about, like I really want minimum 4% annual base rent increases. We're still getting, we're not getting a lot of pushback. 4%. A year ago, I was getting 5. I've got 2 proposals out right now with 4, and that's kind of my floor. And look, I'll show you my hand, right? I'm not saying 4% increases. I'm just doing the math and saying, here's your rent schedule for the next 3 years.
Mm-hmm. Mm-hmm.
And most, if there's an agent on these smaller bay deals, it's a residential agent. They're not backing into it. They don't know what that market is. We're tenant repping a small industrial user, and we're fighting over 0.25 percentage points on those rents, right? I think the landlord was at 3 and we're pushing for like 2.7 to 2.5 on the annual increases.
Where do you see a lease, let's say, within 12 months? Market, does it support right now, do you think 4% compared to like in 12 months right now? Did you see 4% increase roughly or no?
In 12 months?
Rental, but like in the market.
Yeah, no, I think it's going to be 3.5. I think is what you're going to see market wide, 3 to 3.5.
Makes sense.
Especially if my argument for getting 5 earlier was that inflation was at 7, and so we're still not keeping up, right? The landlord's purchasing power is still going down. And so now I think at 3.5-ish, I think you're a little bit ahead of inflation, so your purchasing power as an owner does increase, but it's not crippling. And a lot of it depends on where that starting rent lands, too. If you're wanting a 2-year deal or less, I'm going to make you pay a premium.
Exactly. Yeah, same thing. Yeah. We're starting, like I mentioned, we used to do like 1-year leases. Right now we do 3 to 5 minimum. We're building in 3% bumps right now. Occasionally I get more, but typically I say
Sure.
in the last 6 months we're about 3%, give it or
Yeah.
take. But you granted, Midwest was always compared to like Texas or coast markets was a little more steady Eddie markets. Rarely we get like 5% bumps. Even Disney World times was challenging to put in 5%.
Sure. I will say having really nice built out spaces removes a lot of that back and forth.
Oh yeah.
Like what I found, if we just overbuild a space and it looks, we take finish selections on the interior from like a WeWork. We want it to feel like a WeWork or some modern co-working space with modern finishes. And so when you go in there, it just removes a lot of that, well, I need another 0.5% or I need 2 weeks free, or can we just do it? The people are like, oh, great, we'll take it.
Exactly. Yeah, exactly. Because that's limiting competition still, even in our market, not too many folks are doing this, or they're waiting until, tenant will command it, but then, just, like you say, Spec definitely picking them out, those small units, definitely gives you a competitive advantage.
Agreed.
Now, before we wrap up, I also want to dig in a little bit, in office. There is a lot of hype going on in office. Office is rebounding and many folks are jumping in, conversions, reconversions. Are you jumping in office? What are you doing, on the principal side? Are you attacking office buildings, converting them to residential or filling them up, dicing them up?
Sure.
What's your take on it?
Well, it's interesting because we're actually a user for office, right? Like we have our own office space here where my team comes every day. And have you heard the phrase like an attorney who represents himself has a fool for a client? That's what I feel like. That's what I feel like as a broker. Our lease expires in 30 days. Mm-hmm. And we were so ate up on trying to buy like a multi-tenant office building because the basis is so low. Right, we're getting, I don't know what a small bay deal trades for there, but like a value add one here is still low hundreds per foot if you can find them. And you could get a good office building $65 to $75 a foot with a garage and a fit. There's buildings trading sub $100 a foot that cost $350 to build 10 years ago. And so the ratio of replacement cost is pennies on the dollar. And what's interesting, if you think about being an operator, if you buy an office building for, let's just call it $100 a foot, small bay deal, your rents are maybe 11 or 12 net and you
Mm-hmm.
buy it for 115 a foot. An office deal, you buy it for $100 a foot. Now the TIs are going to be very expensive, but you're renting for 20 to 25 net
Mm-hmm.
for that same building. Just you're getting double the NOI. Now your TIs are a lot. And so if you can figure out the construction piece, which we think we have, there's a lot of upside in an office building. And you're starting to see trades come back. Houston, if you look at, and here's the danger with just aggregate market report. We had the CCIM forecast competition last week, and the two office guys said, look, on paper, the Houston market has 22% vacancy or whatever it was, at low 20s,
Mm-hmm.
which sounds really, really scary,
Yeah.
right? That's 1 out of every 5 square feet of office space is available. But if you there's two kind of submarkets that are like just dead, for lack of a better term. If you were to demo the vacant, see-through trash buildings that no sophisticated tenant is going to consider, it goes down to 10% vacancy, which is now getting into landlord leveraged, right?
Mm-hmm.
Trophy towers that are 50 net, which is a big number in our market, 50 net, and that's Class A plus. You're getting into the 70s or almost 80 in gross when you put the expenses on it. That's an expensive building here. They're all great. They're all full. They're doing deals. They're penciling. For our investment model, I don't know who buys it when you're done.
Mm-hmm.
So if I found a good deal on an office building, it would have to be a really good location that I could see having 20 years to run, just because I'm like, I'm going to own this building for a long time.
Yeah.
So is this where people want to be? And for me, that means, is it surrounded by nice houses with college educated workforce? Because that's a lot of the people occupying office buildings right now. So we took a run at some, going back to having a fool for a client as ourselves. Like, we waited too long and we had to kick the can. We had to do a 1-month extension, and then we had to scramble and find another deal. So we've signed our deal. We move April 1st into a building we don't own, but the building we're going into, I have met with the group that owns it, and they're open to like a partial sale. Like they said, hey, you could buy in and you could be an LP and own part of this building, which is really interesting for us. So, we're going to continue those discussions. But yeah, I'm a big fan of an office building. I think raising capital is tricky, and I think finding your end buyer would be tricky. So be ready to hold it for a while. But I think just as a cash flow investor, the basis is so attractive that I think if you're comfortable holding it for 10 to 15 years, you're going to make really good money.
Yeah, definitely mentioned that interesting point that capital is still hard to raise for office. Another thing, what is really challenging talking to office operators here in Chicagoland, banks are pretty much, really reluctant to participate in TIs. So TIs are being done with, bridge debt or mezz debt. And I think that's really, really challenging. And I don't know if that's Chicagoland phenomenon. How do you see that in Houston? Is Houston banks the same way, that they're very reluctant to fund TIs right now? Or you can get those deals done?
Man, I haven't been on principal side of an office building to really kind of get into the nuance of the capital stack, but I feel like the TIs are killing deals talking point has been around my whole career. I don't think there's ever been a time where somebody is like, oh, construction is really making office deals easy right now. So that's for us on the construction side, one of the things I've extended to some landlords and property managers I know is I said, look, I'm such a believer in spec suites that I'll build it for cost and you can pay me the profit when a space leases.
That's interesting.
Right? Like and I don't even need to pay my project manager. Like, I'm not even saying my overhead costs. I'm saying just all of my subcontractor costs. And I'll get in the risk game with you, and we'll just sit here and it's going to lease in the next 3 months. I just know it will.
Yeah. But when you say you're building out spec, you're still going to that analogy of building only the lobby, right? Because I still think, building spec more than, my comfort level, like 3,000 square feet, it seems like kind of really real risky. What spec you talking about building out as an office?
Sub
how large are
5,000
the
feet.
spaces?
I would do sub 5,000 feet.
70?
No, below 5,000 feet.
Oh, below 5,000. Yeah. That's what I mean. Yeah, below 5,000. Yeah, probably 3,000 to 5,000. I get it. Yeah,
but
because that's more or less
in Houston, there's so many good submarkets. I'll give you an example. There's a family office group, Metro National. They have some of the best located office product in the city. They just bought a relatively newly constructed tower that became available as part of an oil and gas merger. Phenomenal location. These guys bought it, and it was 100% vacant. Okay, so they bought this building vacant, and in less than 10 months, they're trading leases that would get them to like 92% leased.
And the magic is because market bounced or because they're doing a lot of spec work?
Yes. The people are back in the office. The work from home experiment was overblown. Like, it's very unproductive. I have a lot of 20-year-olds at our company, and they always talk about the vibes are strong in the office. So so that's what we're seeing is like people want to be in the office. They want to be in really good locations, and they're going to pay for it. And the construction's just going to get done, right? They have to reconfigure it as a single tenant building. But when you go from 0 to 95% leased and you've got the capital to get it there, I mean, that's a win, right? They didn't buy a 100% leased building, but if you can, the broker fees plus the TIs would still be cheaper than it would be to rebuild that building.
So true.
So yeah, I would not be afraid if I had a well-located office building to spend the money on construction to make it nice.
That makes sense. Totally makes sense. All right, Nick. So I think I would like to wrap up with plugging on any of your projects. Do you have any projects on your desk right now? You're raising capital. You need to sell. You need to move. That's the time right now to plug in.
Okay, so we're doing a multi-property fund. Historically, we've been doing a lot of we find the deal, we tie it up, we raise the money. We just closed our largest raise to date. It's going to be probably a $5 million acquisition, including construction. And that one's closed and raised. We did it in less than a month, which was kind of fun for us. Our multi-property fund, we're targeting a $50 million raise. And the logic in that fund is when we have the capital committed, we can do a faster close and get a better basis. And we can also get a better price per pound, meaning like buying bulk, right? I can now, if we have 50 million committed and we bolt another, call it 50 in debt, we've got $100 million of purchasing power committed, where then we can go out on the acquisition side, go to these owners of some of these like older, well-located portfolios and be like, hey, we'll buy everything and we can close in 30 days. All I need is a survey, an environmental, and a clean title policy, and you'll get your money. Versus most operators are looking for 45 to 60. And I'm saying not 30 days of due diligence. I'll take 21 days of due diligence. I'll light a fire under all my consultants and I'll close in 30 days because I already have the capital committed. So I think that only improves our basis and levers up those investor returns by operating faster. So multi-property fund, I'm happy to chat with anybody about that. It's, SEC registered fund and we run it through Juniper Square. So it's all compliant and you can kind of see our track record there. But yeah, that's our biggest raise right now.
And the thesis of the fund, multi-property. So which asset class are you targeting?
Small bay, multi-tenant industrial.
Awesome.
Well, and that's where the track record is, right? For our office discussions, I see a lot of upside, but I'm going to do that with me and my partners separately. We'll experiment with it. We'll go get proof of concept with our own funds before we kind of take because we just feel we want to be really good stewards when people entrust their assets with it, right? We have a lot of family offices and people that have just spent generations building up a pile of cash that we want to be very, very protective of. And so we're not going to be like, hey, we've got this office building that we want to try our hand at. That's not our thing.
That's exactly right. That's how I feel about it. And I wish all the industry would feel like that.
That's right.
Great. All right. So where people can find you, what's the best way to contact you?
I'm on LinkedIn. Don't DM me because everybody on there is trying to sell me something, but I am there. Add me. Say you heard me on the podcast. That'd be great. Rifle CRE on Instagram. RifleCRE.com is our website. And I think we're going to be launching some stuff on YouTube pretty soon. So yeah.
Awesome. Hey, Nick, thank you very much. It was really informative. I learned a lot. I'm pretty sure everyone on the other end also just soaked in your knowledge. I hope we're going to do another one soon. I'll see you in Atlanta, man. And I really will appreciate that.
Thanks, man. See you soon.
Thank you, buddy.
You've been listening to the Value Builder podcast. For more strategies, stories, and episodes, head to valuebuilder.co or subscribe on your favorite app. Always make it better than you found it and keep adding value. See you in the next one.